We get a lot of questions from investors about global equities and can equities continue to rally in the face of such a challenging economic situation as well as aggressive monetary policy. And we think that equities can. We think that the equity market and earnings growth can remain positive in 2022. But that does not mean that we expect the same double-digit types of returns that you've seen in prior years. We think you're going to get much more muted levels of returns in the equity markets. And discipline as well as diversification is very important in order to achieve these levels of return. There's one thing that we've seen in the equity markets in the first quarter where we think there are some opportunities, and that is almost those areas that have overpriced pessimism. We saw that in international equities. We saw how international equities were basically sold across the board because there was a major concern about what the economic environment would look like because of the war between Russia and Ukraine. International equities they were cheap coming into this crisis, but they are now historically cheap versus U.S. equities, and we think that they're overpricing the pessimism in those areas. We think that still is an opportunity, specifically the developed international markets. Within the U.S., this is going to be a bit challenging because the U.S. is very focused on technology, and technology has benefited for years of very easy monetary policy as well as speculation. These things are getting washed out of the market right now because the Fed is basically doing a complete about-face on interest rate policy. We're now talking about higher interest rates, higher inflation. This is something that we'll see a continued valuation correction in those very expensive, high growth names. So selectivity is very important in the U.S. market. We still think there's room to run in the U.S. market in some of those cyclical areas that actually have some pricing power. Those are areas like the value areas, that is energy, financials, industrials. Now, there is one area of the market that has been completely unloved in the U.S., and that is the small and mid-cap space. If you look at this table, you can see that the small and mid-cap, specifically on the growth side of the market, have seen some pretty substantial declines over the past year, nearly in bear market territory. But those are the areas that, even though we've seen a slash in earnings estimates, we're still looking for very decent upside potential in earnings. Those areas are ones that we would take a look at, especially selectivity, active management in those areas. These active managers will be able to pick apart those winners versus the losers in the small cap space. So there still is opportunity there. Now, within the emerging markets, we're still exercising a bit of caution there because there is so much uncertainty, and we are seeing a lot of volatility around whether it's COVID lockdowns or additional stimulus. Obviously, the war between Russia and Ukraine has created a lot of sentiment deterioration in that area, so we're exercising a little bit of caution within the emerging markets, but doesn't mean that we won't see opportunities this year. So within the global equity markets, you have to be selective, looking what's overpriced the pessimism. Those are the ones that will rebound the most when we start to get out of the current economic uncertainty.